Well, good morning, everyone, and thank you, Martin, for your introduction. So, my name is Ajit Mandraker. As Martin said, I co-head a business called River and Mercantile Solutions, and we are a specialist investment consulting firm that work alongside your actuaries, your accountants, your legal advisors, again, in helping insurers on all aspects of their investment arrangements, from strategy to implementation to ongoing governance. Now, what we thought we'd do this morning is really host a webinar that takes a look at some of the key themes facing mutuals today, and in particular reflecting, as you'll see from the panel participants, on some of the questions, some of the discussions we've been having directly with clients like yourselves over the last month or so, particularly as the impact of COVID-19 has played out. But to start things off, what I'll just share my screen just to sort of tee up the discussion we're going to have today is very much around the following areas. So hopefully you'll see this in front of you. So again, the key themes we're facing, but to kick things off and just a recap in terms of what we've been seeing in terms of a recent market background. So as you're all no doubt aware, it's been a very volatile period. Having had a sort of relatively benign first couple of months of the year, markets have fallen off significantly as the spreading of COVID-19 has sort of translated to lockdown effects across countries, regions, sectors, industries around the world. Now, coupled with that, we've seen a significant level of fiscal stimulus, which has certainly provided that support to countries and regions around the world in different shapes and forms. And that's really underpinned some of the bounces we've seen probably from the late part of March through into April. As again, that stimulus, that welcome financial support from central banks has served to see markets bounce up a little bit and recover some of that ground lost. But again, one of the things we're going to talk about today is, given where we are, the key point of all of these discussions is, where do we go from here? What does that outlook look like? And how are we helping insurers like yourselves think about that in terms of what they're doing? A couple of points to note is, again, while there's been a positive bounce so far, again, if we look through to company earnings, and a lot of companies have been reporting over the last few weeks, starting with financials, a lot of financial companies are reserving billions of dollars to support expected loan losses that may come through later on this year. And it calls into a similar question, as we'll dive in later, around what's that happening to other sectors? Are balance sheets under strain? Are dividends getting cut? And what does that mean going forward in terms of the impact that might have elsewhere? So to help facilitate that, we've looked at three key areas that we're going to look at. First of all, from an investment perspective. Secondly, in terms of as we look at clients and the liquidity within your portfolio, the level of cash flow you've got on balance sheet, and the demands on that cash flow going forward from here. And thirdly, to think about that regulatory backdrop. And we should go back to the screen. You should be able to see me on screen now. To do that, what I'd like to do is to introduce the panelists that we've brought together today. And again, alongside myself, from an investment consulting standpoint, we've got David Gray from OAC. He's a consultant actuary with over 20 years experience and leads their technical research. Secondly, Paula Gaddam from Eversheds, partner in the insurance and reinsurance team. Again, many of you may well have met and know Paula directly, and she's got extensive experience in the realms of drafting and negotiating insurance market agreements. But more importantly, again, if you've been on their website, Paula's written a number of topical articles, given recent guidance coming out, draft guidance from the FCA, that are well worth a read there. And finally, Jonathan Marriott. Jonathan's the CIO at LGT Vestra, and again has been investing in markets for over 40 years. And that very much tees up some of the points we're going to talk about, because while often we hear the adage, well, is this time different compared to last time? And again, we look at what happened in the financial crisis. Again, having invested through these periods, what I thought I'd do in terms of the questions is start from an investment perspective with Jonathan. Before I do, just a reminder, the chat facility is open on this forum. So again, if anybody has any questions they want to raise as we're talking through, please do ask us. And again, I'll direct them to our panel accordingly. But as a starting point, so over the course of this year, the FTSE's clearly bounced from the market March lows that we saw, but it's still a long way down from where it was at the start of 2020. So as a starter for Jonathan, if I may, how are you positioned going forward from here?
Well, I think one of the questions we've been asked about is overseas equities is one of the things. And while the FTSE is down 21%, the S&P in sterling terms is only down 4%, and the Nasdaq, which is more tech heavy, is up 8% in sterling terms. So it's not as bad. It's not as bad if you've had a diversified portfolio overseas. And we've been increasing our diversification to overseas markets. This has been helped by a weaker sterling. And basically that's, I think, likely to remain in place. We've got another round of Brexit talks going on in the background, which people haven't focused on. The FTSE index is a particularly troublesome index on the basis that historically it's had a very high commodity and oil content, and the oil market was particularly hard hit. Not so much by the COVID virus, but initially by a dispute between Russia and Saudi Arabia, and Saudi Arabia actually increasing production at a time of reduced demand. As it is, they finally agreed a cut of 10% production, but actually the cut in demand is more like 30%. So the oil price has collapsed, although it's bounced a little bit more recently. So as far as positioning is concerned, we believe in sort of quality, in a quality growth bias, which means we've got some technology and a generally underweight. We've been underweight oil stocks and are not great fans of that sector. And we're not huge fans of the UK because of the biases within the index. So for those that have to have UK exposure, we have exposure, but we believe that a selective exposure to equity is important. On the bond front, we've actually seen 2-year gilt yields go negative this morning, -4 basis points. So we've had some bond exposure, but through the US on a currency hedge basis, we hedged the exposure. The US interest rates are higher, and so have got further to go in this crisis in terms of the cuts. But we think interest rates are going to remain low for a very long period of time. I think when we come out the other side of this crisis, interest rates will be low. The dispersion of returns as we go through this crisis has been enormous, and we think that that's going to continue with, as I say, those with quality balance sheets that can survive this kind of thing coming through and looking very attractive when interest rates come out of this with sub 1% interest rates. They will look attractive. The UK market has also been very heavily dependent on dividends, which you mentioned earlier. And certainly the dividend futures would indicate, and the cuts we've seen would indicate, that next year dividend yields will be roughly half what they have been for the UK market. Maybe possibly even lower than that. So instead of getting a 5% dividend yield on UK equities, you're going to get 2.5%. With gilt yields are at 0.2, that may still look attractive, but it's not. It's going to be a different dynamic in terms of the way you get rewarded.
And I guess just linking off that backdrop, David, if I can turn to you, are you seeing clients take any particular management action or otherwise, given the market movements over the course of this year?
Well, in line with consultation with investment managers, I think many clients will have broadly maintained their asset mix, just trying to keep with it, and certainly not, unless they're subject to particular triggers, including liquidity. We'd expect them, as I say, largely to hold on to their assets and see the long-term value there. So, yeah.
Okay, and I guess looking beyond that, in terms of as we look going forward from here, the subject of profit smoothing is also a key topic that's coming out from a lot of clients. What are you seeing from that standpoint?
I mean, it depends on the extent to which firms recognise the extent of their smoothing that's already there, and their fairness in treating policyholders, I would say, but certainly possibly bringing in the bonus aspects. I mean, this is a continued discussion between looking at the balance between guaranteed and discretionary benefits, and so potentially along those lines, the potentially final bonus scope is reduced. With reversionary bonus, we've perhaps been seeing a trend to maintain bonuses, and perhaps with an expectation that there'd be an upturn there. So we think that is fairly unlikely now. And again, we'd perhaps expect the reversion bonuses to reduce. There may even be some element where the people postpone declarations and maintain lower interim levels as well. So it's probably just part of the wider thing in terms of, for example, a guaranteed reviewable policy. It's that balance between guaranteed and discretionary benefits and the regulatory restrictions that come with higher guaranteed benefits.
Absolutely, and I guess it's a useful point to turn to Paula from a legal perspective in terms of, again, notwithstanding regulatory guidance, what your thoughts in terms of, are there any legal implications here as management teams look to exercise what discretion they have?
Yeah, obviously they've got to be managing resources prudently to ensure they can meet their commitments to policyholders. And obviously the PRA will be taking a close interest, because it's got to be demonstrated to the PRA that they can still meet requirements of supervision in accordance with their, I think it's statement 418. So any payments that are made must be appropriate, bearing in mind their activities and also their future capital position. So I think basically tread carefully, isn't it, to make sure that the PRA are not concerned by the actions.
No, thank you for that. I think one extra bit I'd probably acknowledge again in terms of some discussions we've been having with clients is, again, given any period of market volatility, one will often find your asset allocation drifts against your risk appetite statement or your investment policy. And again, one of the things we've been arguably advocating to clients is there's likely to be a fair bit of uncertainty ahead from here. Again, it's important to keep some dry powder back in terms of, because there will be volatility going forward, there will be other demands on your capital. And again, understand how quickly you put money back to work from that standpoint. Similarly, I think one of the other points that again is prudent for again, members listening on the call as well to have a look at is, again, think about the investment guidelines you've got in place today. How much flexibility does your manager have in that space? So again, one of the areas that Jonathan touched on this as well is, particularly as we look at how different sectors emerge from this lockdown environment going forward from here, one of the things we may see is particularly if you've got credit portfolios as well, you may see some downgrades come through. You may see some default expectation be slightly more elevated than it might have been historically. So how much flexibility do you have in your portfolio is key, but also understanding what do you have in your portfolio as well. Again, how is that expected to behave and respond going forward? So again, a topical point there. What I thought I'd now turn is just to talk about the next section in terms of liquidity and cash flow. And I know Jonathan's comments around dividend expectations, but if you could expand on that a little bit in terms of how are we seeing investment-related income impacted going forward as a lockdown environment unfolds?
I think from our client point of view, generally we look at things more in terms of total return. I think it's difficult to view it as whether it comes from dividends or share buybacks. It's the return to shareholders, and certainly the regulation has been such that as part of the loan packages, and just there's been sort of moral pressure on companies to cut dividends. The banks have been instructed to cut dividends and to cut share buybacks. This for us favours actually the credit markets, where when you've got that, basically there's moves to protect balance sheets going on, and central bank buying of credit means that credit spreads, which ballooned out in March and have come back as the Federal Reserve, for instance, has announced buying of credit, means that I think that we think that credit spreads will actually could tighten from here. And so in the bond market, we favour credit over certainly high grade credit. But again, anything you do has to be selective. As you said at the beginning, the Q1 results are out. That was perhaps just a few days of lockdown in those results. It's nothing. Q2 will undoubtedly be hit hard. The numbers, the economic numbers are going to be a huge slowdown. Nobody knows how bad it's going to be. And frankly, the depth of it is not as important as the way we come out of it and where we're going to be, the shape of things to come. And I think that there will be a dramatic shift One of the areas you talk about income, I think you've got some people who've got property investments, and certainly I sit. Well, I'm not a property expert. I do sit on a number of charity investment committees where we have property holdings, and we're having to offer rent holidays, deferrals to many of the people who the tenants are there, depending on who they are. There are other people who are being slightly cheeky and saying they're functioning fully from home and then actually asking for rent holiday because they're not in their office. But that's slightly different.
I think go on, John.
Income is going to be lower across the board. Bond yields are going to be lower. Dividend yields are going to be lower. So if you're reliant on purely segregated income flow, then that's going to be much more difficult.
I think that's an absolutely key point that Jonathan makes there as well, in terms of, it goes back to my point about understanding what's in your portfolio and understanding what sectors do you have exposure to across different asset classes. So while in theory having different asset classes gives you diversification, if you do have a concentration in whether it's your property portfolio that might be direct or held through funds, as well as other parts of the portfolio to certain sectors such as high street retail being the obvious one, that may have implications from there. Sorry, Jonathan, you were going to say.
If I could just add one thing on this, I think it's more than just a sector allocation. It's down to the individual assets, the individual companies within the sector, because there's a dispersion between those that have got the right balance sheets to cope with it and those that haven't. The right tenants who can continue to function. A pub is not going to function at all. A shop is going to close down. Some shops are opening again. There's a huge dispersion within sectors even.
Yeah, absolutely. And I think one of the other points just to raise that came up last week when talking to some of our other insurance clients in this space was, again, just looking at how we forecast that income that you might have been expecting to receive as a key component to sort of balance sheet and cash flow within a mutual or other type of insurance company, and then thinking about how has that been impacted from here. So to Jonathan's point, yes, dividend incomes are likely to be down. Yes, the yield from your bonds or the coupon payments, we may see some holidays from that, or again some deferment from that. But another point to raise as well is, again, when you see markets fall as they have done, again, those mutuals that have a unit linked part of their book, and again where those unit linked underlying funds are linked to, say, the FTSE or otherwise, that's a prime example where, with the FTSE down, the level of investment income from management fees will be markedly lower. And again, one of the things we're looking at the moment is, again, how do you factor that into how the balance sheet and cash flow position will evolve going forward, not just this year, but again looking out beyond that. I guess turning to the other side of the coin, in terms of what about managing liquidity from a policyholder perspective, and if I can turn to David and then Paula, in terms of how you're seeing clients deal with the risk of heightened lapse risk or potential premium deferment given draft guidance from the FCA. David, do you want to start that first?
Sure, thanks, Ajit. I mean, just stepping back a bit, I'm interested in Jonathan's comments. I mean, Jonathan's comments obviously from an investment risk and this dramatic impact. The question that I keep asking in terms of the insurance risk is, are we overstating the impact of COVID-19? And that is just where there's just massive uncertainty about it. We need to be aware of our biases. We're faced with rolling 24-hour news. The extent of other news is entirely limited. We're also have this balance between short-term and long-term products. Long-term products affected by long-term assumptions, and it's really there's just right now we are still relatively ill-informed, I would say, and we haven't got that experience behind us. So it is an interesting split, which I say I think we just need to monitor, and that's going to be a feature through all of this. But certainly focusing more on the cash flows that we see from the societies, the insurers, there is undoubtedly some concern about lapses. There is also the interaction with the regulatory guidance, which can be have quite a big disruptive effect, and assuring that whilst they obviously are keen to be fair to consumers, insurers will be keen to be fair to the consumers within their book. and rather than select against others. So need to ensure that the premium income levels are maintained, especially in the light of potentially lower investment income, and looking at what can be done to perhaps stop lapses. And a key concern would be where a direct debit ceases, and the likelihood of reinstating that direct debit might be low. On the other side, because again, we should bear in mind that there should be positive and negatives alongside this disruptive crisis. So there are risks and opportunities. But say, for example, for health cash plan providers, so whilst we've been looking at lapses in premium income, some of these will have potentially lower benefit payouts. But the question that I think we'd ask there is that whilst we see a drop in claims for particular treatments because we're restricted in terms of visits to dentists, etc., perhaps does that represent just a change in the timing rather than the amount? Does it represent a deferral of those claims, and it's just pushing that cash flow later on? But over the period, are we going to see similar claims? So, lots of uncertainty is what I would say, and just trying to do the best to manage that. That would be my general comment there.
Paula?
I agree entirely. And it depends on a lot of the insurance particular product as well. As you say, that if you take health insurance, there will be savings on claims due to simply practicalities of getting and treatment and the use of private hospitals to the extent they are being used by the NHS, etc. So there'll be savings there, but then you may get customers cancelling policies, etc., because they don't see the value at the moment. And then do you try and stop them cancelling to keep your premium income in by adding extra benefits to demonstrate as well that there are other benefits that they can still get under the policy? So do not cancel to keep your premium income. So there are lots of, as you say, positives and negatives around. And the FCA, obviously, with their comments regarding you've got to look at products, everybody's got to look at products. Are they still of value? That's ensuring that insurers are looking at these things. And then if policyholders are having difficulty with payment, should they be deferring premium payments, etc.? So there's a lot of pressure, I would say, put on the insurers by the last FCA announcement as to how to actually manage this process. And I think that takes us on to governance in relation to that and how you deal with that. I don't know what to deal with that separately, but just on this specific point, yes, there is a lot of uncertainty and action that needs to be taken by insurers now in that sort of uncertain environment as to what they should be doing in relation to premium income, etc. So yes, a lot of uncertainty, and it depends on the product.
Absolutely. I'll come on to the governance process aspect in a minute, but I think certainly just to echo what we've been seeing more recently and being sort of asked to take a look at, it is certainly that aspect of not just stressing, as I said, on the income side, and again how you forecast your cash flow coming into the society over the next 12 to 24 months, and again how you're adjusting for that now. But exactly to the point David and Paul have referenced in terms of understanding the different lines of business and types of policies you have, and that will clearly vary from society to society, but certainly the impact of that, not just in terms of managing cash flow, but equally on retaining those policies, retaining those members. Because I think two key points to recognize is, as you said, if you've got a policy on a direct debit, the moment you switch that off, you're back to square one and starting that on again and finding mechanisms to do that. But the other point that I've seen more recently, and again, we've been sort of helping clients think about this, is that deferral point. Again, if dental is one example, as well as sort of private medical care or what have you. Again, from talking to some of those entities directly, yes, they're not doing having a lot of claims pay out today, but as soon as everything starts to settle down, they're expecting all of that elective surgery or what have you to come straight back online. and that's gonna by virtue of that trigger a big drain on cash. And again, how we manage for that going through this period will be key. But going back to Paula, if I may, in terms of adapting governance processes through this period, again, what tips are you seeing from the work you're doing with your clients?
I think it's a case of ensuring clear processes, clear decision making, and documenting those processes. You need to be able to demonstrate that you are treating customers fairly, looking at product valuation, looking at the financial position, looking at vulnerable customers. All needs to be considered and documented. If it's not, I think that then there will be time when the FCA look back and then it comes on to potential, enforcement actions, etc., if they find failings. So it is very important to ensure that clear processes is in place now and it's all documented.
Thank you. Does anyone have anything else to add on that? Okay, if I can sort of go on to the regulatory backdrop, and again, sort of reflecting on draft guidance that came out earlier this month. If I can start with Paula in terms of your thoughts going forward from here, obviously in terms of wider processes, but as we look forward, just not to the sort of immediate implications, but again, looking out for the next 12 months and beyond. What are you seeing from that standpoint in terms of how further regulatory influence may play on the societies and the market as a whole?
I think we're going to see more influence from the FCA. They have been very active, as everyone will have seen, for the last 2 months, and I think that's going to continue. And again, it comes back to the usual mantra of treating customers fairly, be aware of vulnerable customers, making sure contact with clients can communicate very easily with you, making sure that, particularly on renewals as well now, making sure that all exclusions are clear. I mean, it comes back to the same thing, clear, fair, not misleading, but there is going to be more and more emphasis on the treatment of customers and ensuring good outcomes. And again, coming back to governance again, fairness across the board. I think you've got to demonstrate and ensuring all processes are in place and everything is considered, and you can show that you considered it. I think it's going to continue as it is now for a few months to come.
Mm-hmm. And I guess turning to David, if I may, looking at clearly solvency positions for societies will have been impacted with the recent market period. Again, what are you seeing, and what sorts of discussions are you having with your clients as they look to navigate their balance sheet and the capital position going forward from here?
Well, most clients have completed their year-end reporting. There's been a big focus on Q1 because of that movement that was seen in the intervening months. After the Q1, we then typically address the own risk and solvency assessment. And in that one, I think a lot of this has demonstrated or may have brought some shortcomings in that planning process. Mm-hmm. So we'd certainly be looking at that and ensuring that your own risk and solvency assessment is fair and covers developments that we've seen. But I think also as part of that, might be appropriate to widen who contributes to that process. Mm-hmm. Mm-hmm. And I mean, there's always concerns about groupthink, and I think potentially this is even more relevant now to get away from it. I mean, we haven't been able to follow the direction of all these developments, and so getting a reasonably wider opinion would definitely be helpful. I mean, certainly in terms of the scenario planning, we might now expect someone to say the scenario to reflect on potential vaccine development. Mm-hmm. Mm-hmm. And we know about the uncertainty of that. Perhaps the earliest might be 6 months, we have a 12-month or an 18-month, or do we even face the prospect of no vaccine? I don't know. But that's something that I think we'd be looking to see come into the scenario plans and how best to adapt with them.
And have you been introducing any particular additional stress tests beyond regulatory requirements to sort of help clients sort of evaluate those scenarios?
Well, the typical variations have been around, I would say, for example, an income protection provider would be morbidity assumptions. But I think it's trying to think perhaps wider than that, and maybe more of a focus on operational risk as well. I think clients overall will possibly be fairly happy with the position they're now at with how they've dealt with this crisis, and for example, moving workers away from the office to home. So that reflects well on planning processes for clients, I think. But it's those wider aspects, the operational risk aspects, that we're all being asked to consider in any case, and that operational resilience.
No, that's useful to point out. And if I can bring Jonathan back in this, just to sort of flip it around slightly in terms of when you're working with your team from an investment perspective, again, when you're thinking about stressed scenarios and again, what could go wrong within your portfolios, as you said, it's a very individual company level point when you're looking through to portfolios. Are there any additional aspects you're looking at as well?
Yeah, I think that when looking at portfolios, there are the scenario of when we're going to get a vaccine, for instance, David mentioned. I just don't know when that's going to happen. I mean, there's huge uncertainty around it. As one does, one reaches back in history sometimes to look for previous crises, and pandemics have been and gone, and we've had crises come and go. And from an investment point of view, there are clearly certain lessons to learn from that. One is that you don't want to be raising interest rates at this time. We haven't seen that. You don't want to be raising taxes during a crisis until after the recovery is well established, which is obviously important. And the other thing you don't want, because it was one of the contributors to the Great Depression in 1929, is a trade war. And I think that one of the uncertainties we've got now is with Mr. Trump. And the bill that was put to the Senate, I think yesterday, that we may get a trade war on top of all the uncertainty. And the other thing that people are not talking about at all at the moment is Brexit. And we've got a round of Brexit talks going on at the moment. Brexit fell from the things altogether. So you have got additional risks from that. I would ask, if you talked about morbidity, I did have a conversation last week with Cancer Research UK. And they were saying 2,700 people a week are going undiagnosed with cancer. That affects your death rate long after COVID-19 has disappeared.
Yep. Jonathan, yeah, just picking up on that. I mean, that's one of the things to consider is, I mean, we know it's COVID-19, acute respiratory disease.
Yeah.
Whilst there's always a concern about the increase in incidence there, it's got relatively low claim cost overall. There'll be relatively quick recoveries, or terminations, sadly deaths. But that's exactly it. I mean, we know acute respiratory, and also sort of linked within income protection providers, we get into this product differentiation, and that will be, the exposure will be there for those with short deferred periods. So we've seen clients react to that by temporarily closing to those short deferred period contracts. But it is exactly that. Cancer and mental health form a reasonably significant part of claims. So are we seeing this by the fact that people aren't getting treatment potentially? Are we then risking, and we know that the correlation between the diagnosis stage and the probability of recovery, so is that then being worsened? And equally, there's talk of mental health as well, which typically does have a high expected cost. And is that worsening? So again, so maybe can clients look at some indicators of that, maybe even look back to those who have had history of, or say, mental health, and put in some preventative measures, perhaps contact clients. I mean, certainly clients will be looking at a range of measures, and that includes wellness apps and such, like all things that are geared to improving mental health. But these risks continue alongside, and in terms of perspective as well, it's exactly that. From the cancer stats, there were, okay, we have, I think the CMI, they have the mortality monitor. And the last one that I reviewed talked about 51 to 59,000 excess deaths. There were 447,000 new cases of cancer in 2018 and 178,000 deaths. We also have to bear in mind that these COVID stats are in relation to the general population, and all the firms' more focused concerns is around their insured population, that firm's insured population, which can be obviously quite a different exposure. So there's lots to monitor, and whilst all this goes round it, firms will be keen to monitor the specifics of their insured population relative to general population, especially when you see features on perhaps increased propensity for older males to suffer from COVID-19. Is there a gender bias in the firm's profile, an age bias, anything like that? It's all down to regular monitoring, really.
And I think that's absolutely one of the key things, again, from what all of the panelists have shared over the course of the last 40 minutes or so. It is very much understanding what's in your book, whether from an investment perspective or from a liability perspective, and how are you planning ahead. But in the last few minutes, if I can sort of open to each of the panelists in turn, is putting the risks to one side, if I may, and I guess there's at least two actuaries on this call, being myself and David, but again, I think we've all presented some of the negative aspects and the challenges going forward from here. But from a positive standpoint, if I could start with Jonathan and then work through the panel in terms of what are the positives you see, or positive developments that we should be looking for optimism going forward from here? Jonathan, do you want to kick off?
Yeah, I think that a lot of the trends that we've seen over the last few years have been accelerated by this. The things like working from home, the use of technology. I mean, who'd heard of Teams, frankly, or Zoom 6 months ago, frankly, who was using Zoom on a regular basis. So I think that there are significant changes in the way that we live and do business, some of which will be long-lived, some of which will be relatively short-lived. I always think that if it ends up costing you more money to change the way you do things, then you probably be fairly short-lived, and other things will be longer-lived. But I think we're going to come out of this with low interest rates, which will be very, very hard to take back. Each time we've had cuts in the last 20 years, they've never got them back to an old high. So I think interest rates are going to be below, say 1, or even you would say 2, to let's say below 2% for the next 10, 15 years. So you've got to get used to that environment. That means that if you've got an equity with a PE of 20, that's an earnings yield of 5%, very roughly converted. That will prove to be attractive. I think that you can justify even higher earnings ratios for growth companies, and there will be companies that will benefit from this and others that will not. But those that will benefit extraordinarily, and they've outperformed on the way down. They'll outperform on the way up as well.
David?
Well, it's difficult as an actuary to be positive on some of these things, but I mean, I think, well, on the wider one, I mean, it's unknown the effect of societal changes. We talked about mental health worsening. Could that improve? With the work situation, increased encouragement to exercise, we value family and friend contact more perhaps out of this. I think it's really difficult to know. I certainly hope that there are positives that come from this, and it's just seeing continued development and welcoming input from sort of various range of contacts, really. Sorry, waffling a bit there. I think that's my exposure to being positive.
That's fine. Paula, anything to add?
Yeah, I think generally, the advancement of technology over the last 2 months and how the businesses operate has just been phenomenal. How Eversheds Sutherland operate now from 2 months ago is the transformation with technology is incredible, and that will, how businesses change and operate, and will change people's lifestyles, etc. So there's no question that, you know, we're not going back. I don't think. Now we've all got to grips with technology, or getting to grips, should I say? But from an insurance business perspective as well, I just think the acceleration of, I mean, I have seen with clients their involvement now in considering how they do everything in their practice procedures, governance, etc. really has increased massively, and I just think I think the running of their businesses will, from an FCA perspective, be much smoother from now on, and hopefully less intervention ultimately from the FCA, although it's heavy intervention at the moment.
Sure. No, thank you. And I'll just add a couple of elements that we're starting to see in discussions we're having now and planning to work with clients going forward from here. I think one point that I touched from the beginning is that notion that we have been relatively cautious in terms of the recommendations we've had to clients to, given the market environment within their investment strategy and their portfolios. However, at the same time, there are opportunities to generate that stronger return going forward from here. And again, there will be investment opportunities that clients should actively, within their own risk budget, be looking to consider to adjust their asset allocation to capture that as and when that comes through. I think the second point that I'd pick up, and this links to Jonathan's comment about interest rates being lower for longer. To my mind, that plays very well to an attractive product lineup and new prospective product lineup for mutuals and societies by their very nature. With profits, for instance, for those who've got strong balance sheets and have weathered the storm, but also as we're looking for new products and again working with clients to think about developing new products to fit, let's call it the new normal as such. I was hoping one of us would get that statement in there at some point, but the principle being though that actually with low rates for longer, that does open up the attractiveness of all the types of savings vehicles that societies have a long history of providing high quality product there. So again, that is an area that we're certainly starting to see interest in, start those discussions around thinking about what products could you be launching next as we come out of this period that really provide the next wave of savings and support for societies. So with that, I was going to thank you all for listening. I hope you found it useful. I think there will be a recording available afterwards, but otherwise I was going to hand back to Martin to close the session. Martin, over to you.
Thank you, Ajit. Thank you to all our panelists, and thank you to everyone who's sat through the discussion today. Hope you found it useful. As Ajit said, we have recorded this session, so if you want to have a look at it again, you can do. If you want to share it with any colleagues, you can do as well. If there are any questions that occur to you after the discussion, I'd be happy to pass those on to our panelists and get a view back from them. But otherwise, thank you for joining us today. Hopefully you'll be able to join us for future sessions that are coming up in the next few weeks. And in the meantime, as we are now getting used to saying, stay alert and keep well. Thanks again. Bye-bye.